Welcome to the Hustlers University presentation on investment overview, a general overview of long-term cryptocurrency investing and a few different techniques, strategies, and things that we're going to be covering this university so that you can have a holistic approach to this asset class. This presentation is designed to address the educational requirements of those who are new to investing and crypto. HU2 recognizes there are many new students who are already quite advanced in their education. Material relevant to them is provided deeper within the university. Okay, the investment overview agenda. We're going to be looking at goals, the starting position, mindset, asset selection, technique, some rudimentary examples, and a summary at the end. So firstly, your goals. You have to know what your investing target is. Do you want to be super rich or just comfortable? What would happen if you lost all of your money? Do you want to make all your money in the market chasing huge returns? Or do you already have a large income and want to supplement it with some responsible returns? What is the playing field and what are these assets capable of? Knowing your goals will act as a compass when looking at things such as your asset selection, how you should behave, and what techniques you should use. Lots of questions that you need to be able to answer when approaching investing. There are a lot of unknowns, a lot of what you would call blind spots that people have. You need to be aware of the things that you don't know in order to survive. And you need to have lots of goals, clear goals that are calibrated well within the context of what is actually possible. So another thing we need to look at is your starting position. Investing is a game of multiplication. If you start with nothing and you multiply it by 100x and you catch a shitcoin pump that just blows people out of the water, you're still going to have nothing because you multiplied by nothing. Therefore, to be successful in investing, you must have the largest starting position possible. I cannot stress how important this is, how much extra money you can make with a larger starting position, and how much less risk you need to take on in order to achieve these things. Investing is a game of addition before multiplication. You need to add money into your account before you can multiply it. So we need to ask, are our goals realistic when the actual behavior of these assets is analyzed relative to what you're starting with? You need to think critically. Are you being delusional? It's okay if you are delusional to start with. Most people are. But understanding what is actually possible and engaging with reality is the biggest hack you can have to accelerate this process and to avoid shiny object syndrome. There are a lot of people coming into Hustlers University with $100, with $200, and they're keen to make it. Look, you're going to need to get more money in. For those guys that have more money at their disposal, fantastic. We understand that that's not for everybody. And we do cover all different situations. You know, if you've got a couple $100 to $1,000, we got some plays for you. If you've got larger accounts, we're for you as well. So we just need to be aware of our starting position and what's actually possible so that we can calibrate our expectations. Otherwise, you're going to be taking on way too much risk. So people see shitcoins going up 10,000x and think, yes, I want that to be me. They're probably thinking, I can turn my $100 into $1 million with one shitcoin. Easy, right? No. That is the exception and not the rule. And investing is all about accumulating either an inside edge or a statistical advantage, preferably both at the same time. We can help you with that. Also, on the subject of being realistic, think about the time frames you're dealing with. You can't get a baby in 1 month by having sex with 9 women. I love that quote. I think it applies very strongly to investing as a technique. Investing is the same. Time compression is exceptionally difficult. Can be done, but it requires a huge amount of work and a decent intellect, to be quite frank with you. Everybody wants $1 million this year, or even worse, right now. And as a result, take on massive risks that ensure they lose everything. We see it all the time. Smart investors want, say, $350,000 this year and $1.2 million next year, because the probability of achieving this compared to the first scenario is way higher. Investing isn't about getting rich. It's about getting rich for sure. Do you want to gamble or do you want to get rich for sure? I'll tell you precisely what my view is, and that is I will do anything to ensure that I become rich because I couldn't live with myself in any other scenario. Ultimately, I will do whatever it takes to make sure I get rich, and I'm going to design my portfolio, my techniques and strategies to align with this goal. No gambling, no betting, getting rich for sure. So, some psychology, just briefly, an extra couple of quick points on investing successfully. Be prepared to treat investing as a piece of life education. Just like relationships and businesses, you never really stop learning. Decide to make investing something that you keep up to date with forever because it's constantly changing. Knowledge is the best time compressor. If you want to get serious about investing and you need to accumulate as much accumulate as much information and knowledge as possible and then use that to select the right assets at the right time. Stocks, bonds, crypto, or commodities, short, medium, and long-term trading, they all have their place. You need to be able to think about this stuff. Asset selection. You need to make sure this is also tied in with your goals. You need to ask which tokens or coins get me to my goals with the least risk, or can I use more than one asset to get me there? For example, there are legitimate ways of combining stocks, bonds, and crypto to get higher risk-adjusted returns over time if you're not just in it for the turbo ape money. There are always trade-offs. You cannot simply trade crypto and expect to be an easy millionaire. You still need to accept that it's just as easy to lose 50% of your wealth as it is to double or triple it. Additionally, some assets are simply designed to fail. So you can start to appreciate that investing is very much knowledge, skill-based. You need to be able to learn, educate, have a desire for this knowledge, because ultimately, investing exists in a free market. We're talking about literal financial warfare. You're going into the market and you're competing, you're fighting to the death with other people to try and take their money from them. We're the best at this, and we want you guys to be as well, but you have to have that killer instinct reflected in the desire to learn. So this is a quick example of asset selection. This is very rudimentary. I'll just show you here on the left-hand side, the portfolio allocations. What we've done is we've taken a portfolio of bonds and stocks and added a little bit of Bitcoin to it. And you can see that it moves up quite smoothly over time. And you get a 3-to-1 reward to risk ratio, which means you actually receive, on average, 3 times more returns than you do taking on risk. That's really, really good for a competitive environment, considering that natural selection brings things back to the mean, competitive environments back to the average over time. Normally, to have this is just a 1-to-1 ratio. You receive as much reward as you take on with risk. But with some asset selections, combining them together, you get some extra rewards. This same thing happens in the cryptocurrency market, even if you only chose crypto assets, if you had Bitcoin and a couple of other tokens as well. Generally, you'll find that you will have greater rewards each unit of risk. That's a little bit more advanced, and we'll get into that later on. But I just wanted to remind everybody that traditional assets do have their place. We want to use the entire playing field if necessary. But we'll move on. Cryptocurrencies it is. Now, when we're looking at asset selection, I love this pyramid here. There's a few considerations that we need to look at. Starting from the most important, capital allocation, where we look at diversifying or selecting between risky and riskless assets and the timing of that. I added a little note over here. I added a little note over here on the analysis that we do here. So when it comes to risk on, risk off, and how much risk and how much riskless assets that we need to have in our portfolios, this is generally the realm of macroeconomic and macro analysis for the market. We take on economics, we look at momentum in the market, and we also look at overbought and oversold conditions for each asset, trying to get the probabilities on our side. Now, overbought, oversold conditions, that is the realm of Dan's dip buying bot. An exceptional tool. If you guys haven't already covered that, you definitely should check it out. It's one of our most important tools in all of Hustlers University for managing our portfolios. Myself, on the other hand, my name's Adam. I cover momentum, generally speaking, and I have a look at how momentum systems are developed in my medium-term masterclass. That's more advanced, and you guys will be covering that a little later on if you choose to follow my style. But yeah, when looking at the highest level, generally this is what we're looking at. Looking at asset allocation, the next most important thing is where we're diversifying among asset classes and markets. Within the cryptocurrency context, this will be between different cryptocurrencies, um, or between cryptocurrencies and stocks potentially. So we look at the barbell portfolio design. That's our favorite for all the different professors. It's a time-proven method and one that helps us manage risk in a way that makes logical sense. So when we're looking at the proportions of risky and not so risky assets and different assets, or what different asset classes we're looking at, we generally try and make a judgment call on our target returns and whether or not we have extra techniques that can help us modify our weightings. If we have a technique that can make one section of the portfolio significantly safer, then we can actually allocate more money to that. Moving on, security selection. This is really getting into the micro. So we're looking at between different altcoins. We're looking at, essentially between different altcoins and stuff like this. So this is where generally crypto plays and signals comes into it. We have a channel dedicated just for this, and all of our signals and plays are viewed through the lens of statistics, volatility analysis, size, and its fundamental prospects. When we combine all of these things together, we design portfolios and we target different assets that give us the maximum probability of getting rich and making good amounts of money for the amount of risk that we take on. Remember, we want to make this as skill-based as possible. We want to remove chance. We hate gambling, so it's all about getting rich for sure. So how do we avoid huge drawdowns in the market? Now, this is something that a lot of people worry about, and this is the realm of technique. So Hustlers University 2 gives you the skills to design a portfolio consistent with your goals, as we've briefly covered, but also determine what enhancements make sense for you. Do these enhancements work? And over what time horizon? Do they require a small or a large time commitment? We're going to be exploring this in all of these different styles here, because at the highest level, you'll have to decide which of these methods is best for you. Long-term, portfolio design; medium-term, which is portfolio design and management; or short-term, which is basically a full-time job and a comprehensive skill that you need to get. When you're looking at the different levels of enhancements for the portfolios that you're running, you need to have a good think about how much time you have. The time commitment is a big part of this. Also, how complex you'd like to get. A lot of people, they don't want to get very complex, so they like to focus on other areas of their life and they just design simple portfolios. You may exist in the long term, or maybe if you're a little more enterprising, medium term. But there are a lot of people out there, and this is cool too, who want to be full-time traders, live the life. It can be not as glamorous as you would imagine it would be. Lots of screen time. You basically need to live and breathe trading. So yeah, that can be short term, using that as an enhancement. And we cover all three in Hustlers University. So this is an example of generally, this is conceptual. So this is what Bitcoin would look like with technique. What you're trying to do is essentially buy low and sell high. Basic enough, right? But this is also a good display of the returns that cryptocurrency as an asset class can get you. A lot of altcoins early on in the piece get you these insane returns, multi-100x returns. And you can see as Bitcoin grows over time, we have what's called diminishing returns. Technique can still help you achieve insane returns. But as you can see, Bitcoin gets a little slower over time, so it becomes a bit harder. Now, without technique, you can potentially make massively bad decisions that will fuck you up for a long time. I know a lot of people, friends of mine, myself included actually, that invested a decent amount of money at the peak of the 2017 bull market. This is peak euphoria, essentially, when Bitcoin was in the news everywhere and everyone's like, well, if it's a new paradigm, I just got to invest in it. So yeah, a lot of smart and dumb money being exchanged right here, basically trapping all the uninformed investors. And you have to suffer through an 84% drawdown, which is not a good time to be in. And it's not just the drawdown. You can wait and you can be patient through this area, but you still have to wait 3 years to get your initial investment back. So think about all the other opportunities that you could have used that money for investing. That opportunity cost in finance is what we call it. That's absolutely tragic, and you want to avoid this. This is one of the reasons why buying and holding investing is not necessarily the best method. We want to have some technique. So this is a rough example of long-term technique. This is just a very basic one, just one of my random, most basic indicators. I'm not sure if it still works anymore, but this gives you a concept of how it actually looks. You say you pull up an indicator and say, I want to form a trading plan around this method. So you buy when it's green, sell when it's red, and hold in between. And this is a good example of the type of behavior you want. Dan's Dipbot actually does a far better job at helping us manage these squiggles than this indicator by itself. This is just an example. So this is an example of medium-term technique. We're going to zoom in on this area for a little bit and have a bit of a think about what we try and achieve here. So you can see that between these 2 points, it's a 1600% return, so 16x essentially. And what we can do though is we can look at the components of this bull run and say, when did the price go up and can we extract more value out of this market? So what we do is we find a method that allows us to trade through these different sections of CHOP. And you can see that compared to the 1600% that you would have achieved through buying and holding, with a bit of technique, you could have achieved 5800x, 5,800, sorry, 58x, 5,800% of increase on your portfolio just with 2 trades. Now this is the holy grail of technique right here. We try, this is obviously, it's possible in hindsight. You can look at it and go, oh, I should have done this here and this here. The question is, how do we develop a system to do this? How do we develop a method that can identify these things consistently into the future? This is what we teach in Hustlers University. And the unfortunate truth of it is, it's going to require some work. If you want to multiply your money like an absolute savage year over year over year, it's going to require you to learn some serious technique. We teach it all here, but it's going to require consistent study from you. This is a great example. I love this one. Investing is hard. So what we have here is a chart of a fund performance, an index versus Ethereum and Bitcoin. DTOP is actually what it's called. DTOP is a tokenized index mirroring the best traders on DHedge. DHedge crowdsources the best cryptocurrency fund managers around the world and ranks them based on their risk-adjusted returns. You can see that even they find it hard to perform better than just buy and hold. So think about it like this. If this blue line here represents the best cryptocurrency investors in the world, and they cannot outperform Ethereum and Bitcoin, or at least they claim to be the best cryptocurrency investors in the world. I think this is pathetic, frankly. Then you have to realize that it's going to be quite hard to develop this skill. But it's not impossible, not at all. And I'll show you why. This is the goal for you. This is a portfolio backtest that I did using a bunch of different techniques of my own. And if you know anything about the portfolio optimizing website that this comes from, probably nobody will know, but portfoliooptimizer.com. You cannot falsify this stuff. I mean, you could upload a custom data set potentially that has some like fake numbers on it, but it would just be too much work. I extracted the return profile from my investing strategies and layered them and formed a very interesting and very unique portfolio technique design. Everything that I teach in my cryptocurrency masterclass. Again, my name's Adam. And yeah, you can see here, you get about a 500% return on average. I mean, this is back test, and a maximum drawdown of 12%. So you can see that when you're dealing with the upper echelon of cryptocurrency investors, essentially, I don't know if you'd call me a savant or a genius or whatever, but I take my work fucking seriously. So yeah, if you guys want to follow along, be my guest. This is the type of shit that we're going to be teaching you, and you sprinkle in lots of smaller portfolio considerations as well in here. Like this is just one component of the portfolio. You've also got all of the crypto calls that go up like 100x from the other professors and stuff. It's absolutely crazy, man. The things we can achieve together, just absolutely unreal. So luckily you've got access to a university that will help you outperform if you learn consistently. And this is just a bit of motivation for you guys. Master Tate. Now, summary. To invest well, you must become an investor. This is a talent which must be learned, like chess. It is not a fleeting interest that you approach through hope, luck, or gambling. The path involves identifying goals, analyzing your starting position, understanding yourself, knowing the pieces, and finally, knowing the techniques. Once you have these in mind, you must choose your preferred methodology, short, medium, or long-term investing and trading. With your commitment and our insights, you will be able to succeed in any of the three. Talk to you soon. Thank you. Hi guys, welcome to Hustlers University 2.0 presentation on price analysis principles, a deep dive on analysis and its core components. In this presentation, we're going to be looking at over some basic principles on how to look at price analysis. Generally, it's kind of going to be a swing trading approach, but you can apply this to long-term trading or short-term trading if you like. I think the principles generally are pretty timeless, so let's just dive right in. The agenda at the moment, the presentation will cover types of analysis, analysis subcategories, application of analysis methods, warnings, and a summary. So there are only two types of analysis that exists in all markets. It's mean reversion and trend following, okay? This covers everything you will ever do. There's no need to know any other foundational principles for price analysis aside from these two, mean reversion and trend following. If anyone thinks that you cannot fit an indicator or an analysis style into these two categories, they are delusional. Knowing which one we are using is key to clarifying our analysis. So mean reversion is where you're trying to capture the difference between where the price is and where the price should be. You can describe this as overbought or oversold, generally equilibrium and disequilibrium. Equilibrium will be close to the mean, where you believe the fair value is, and disequilibrium really is any price that sits away from this mean. So when you're buying, you can try and sterilize this difference by reverting back to the mean, buying here and then selling it once it reaches here, or short selling it here and then buying it back once it hits the mean. That's what a lot of people like to do. They like the idea of buying the bottom and selling the top, although really that's an inaccurate description of the way that this method should be run, which is buying the bottom and selling the mean. You shouldn't be trying to buy the bottom and sell the top. Ultimately, that's a little bit, well, it's possible, but it's very, very tricky. We'll discuss that a little later. So trend following is where you're trying to capture a continuation of a price movement in any direction, up or down. So if you have conditions that are meant that describe strong momentum, you buy here and then you follow it up as long as possible until you either maybe you'll get lucky and get an overbought signal over here. Overbought signal over here, or you have a momentum signal that shows you that something is slowing over here. And then you sell out of the position and you take the trend, the majority of the trend with you in price appreciation. So additionally, there are only two types of signal in each category being the mean reversion and trend following. We can actually break those down into two types of sub-signals. So these are continuous and discrete signals. Continuous signals is where you have a signal that operates along a scale, weak to strong. It's more fault tolerant, but leaves room for interpretation. It's difficult to follow, but it's roughly correct in all scenarios. So this is one where it tells you something is quite strong or quite weak, but it doesn't give you a defined signal. A discrete signal is where you have a signal that is binary. It's either on or off. It's very clear. It's less fault tolerant, but it's less fault tolerant, but leaves no room for interpretation, which means it's easy to follow, but can often be wrong. Often, with a discrete signal, you'll have something that says, yes, this is precisely the bottom, and then it'll keep going down. Maybe it's only accurate 60% of the time, but this is where we have to combine both of them together. Obviously, combining both of these is the most useful type of analysis, but it requires more work. For example, you only take a discrete signal when the continuous signal is saying the same thing. So let's dive a little deeper into this. For mean reversion, where you're trying to buy low and sell high, A continuous overbought oversold indicator kind of looks like this. And I've used this as an example. This is called the stochastic heat map. Maybe ignoring this analysis down the bottom here. If you look at the chart, you can see that when the price is low, it's very, very cool. You could call it, cold and hot because it's a heat map. Blue, very cool. Dark, dark is very cool. And then as it gets super high, you can see it goes red, bright red. It's very, very hot. But at no point along here did you really get a clear indication that this was the precise bottom. It was telling you we are cheap in this area, or we're very expensive in this area. But there was no one particular moment where it said, this is it. You can see it repeated down here as well. It goes back to blue for being cool. For mean reversion, a discrete overbought and oversold indicator looks like this. And this is one you should all be familiar with eventually. It's Dan's Dip Hunter bot. So you can see here that it doesn't really tell you whether or not this is super low or super high. I mean, the colors do change. These little indicator triangles here, the Doritos I like to call them. But the tops, you can see they're all the same as well. We get a bottom indication here and a top indication here, but this top indication isn't actually the top of this larger macro cycle. But that's okay, because we get some buy signals in between. But you can see it's a discrete one because it tells you this is the bottom, this is the top, this is the bottom, this is the top, this is the top. This is an example of where you're trying to incorporate continuous signals into this as well. Look here, you got a buy signal, and that was a discrete signal that said, yes, this is the bottom. However, the continuous signal was showing that it was still quite a bit warm. It was still a little bit warm going down through here. So maybe it wasn't a higher probability signal. So these are the types of analysis that you need to do to combine the two together. Moving on to trend following, you can see a continuous trend following indicator, something that shows you the trend strength, kind of looks like this. And this one here is called the directional movement index. I added these vertical lines myself to give you a better idea of what the analysis looks like. Remember, these are just examples. There's hundreds and hundreds of different types of each of these types of indicators that you can choose from. These are just examples. So you can see here when the orange line or the brown line, depending on if you're colorblind or whatever, the brown line, when it is above the blue line, we are in a negative trend. And then when the blue line is above the brown line, we are in a positive trend. And you can see it flips backwards and forwards, and the distance between the two and the red line indicates how strong the trend is. So you can kind of just say that it has a bit of a discrete signal because the crossover signals that you're changing from a negative to a positive trend. However, it's more along a scale. There's no kind of thing that says, yes, this is precisely the start of a new massive trend. We kind of do with the crossover, but again, there's multiple stuff to interpret in here. So we have a very strong trend over here because the red line and the blue line are quite high. Strong negative trend there, close to the bottom. Strong positive trend here, going up through there because the red line and the blue line are quite high. Strong negative trend here, strong negative trend here, and the cycle repeats like so. For trend following, a discrete trend indicator looks something like this. And I selected this one because it's a classic, super, super classic, the moving average crossover strategy. It will give you one signal and it says, now we are about to enter a negative trend. It is super unrefined, very, very unrefined. Again, example, this isn't something that I recommend you go out and grab immediately. This is just an example. There's hundreds of different types of trend following indicators like this. But yeah, you can see that it tells you this is the time to get out of this long trade. And this is the time to enter a long trade. You get those signals going up and down like so. And it doesn't tell you the power of this trend, the power of the trend in either direction. So when you're a hammer, everything looks like a nail. This is kind of an old saying that I think applies to this. When you're new, if you're a newcomer, you'll often become obsessed with finding the perfect entry and the perfect exit because you want to buy low and you want to sell high and capture 100% of the move. You might not realize that you're deploying an ineffective mean reversion strategy while completely ignoring the trend strength aspect. Remember, tunnel vision on bottom and top picking can prevent trends from being captured. But also, tunnel vision on trend following can prevent amazing buying and selling opportunities from being exploited when things are very expensive or very cheap. Obviously, all of this results in money and time being lost, which we can rectify through better analysis. We want to include a little bit of everything. We want to have mean reversion, we want to have trend following, we want to have discrete and continuous for both. So let's have a look at some examples. We'll just do a very broad overview first of what it looks like in my mind, at least. So combining the best steps of everything. For long entries, you can have two different forms, and you can put them together in the same strategy if you like. For long entries, we have oversold conditions resulting from a mean reversion system. This would be a very strong bottom indication. But you can also get a long entry from positive trend conditions from a trend following system. So if you miss the bottom, then you still have a backup where the thing re-enters a positive trend. A great example of this is if people are trying to use Dan's bottom buying dip hunting algo and they miss the bottom signal, well, they still have an opportunity to jump into a positive trend slightly later on once we re-enter that. Now, combining the best steps for long exits, they come in two forms. So you can either get overbought conditions resulting from a mean reversion system that says, yes, this is the top. Obviously, those are preferred. That'll be profit maximizing. However, they don't always trigger. Like I said, they're less fault tolerant. So as a backup, you'll have negative trend conditions from a trend following system so that you can take the meat out of the trend without needing to worry about whether these thresholds will get hit. Clearly, this is not as optimal as getting out up here, but getting out here is more optimal than getting out at break even or even at your stop loss because you just sat in this entire trade all the way down into oblivion because it missed the top mean reversion threshold by like 2 millimeters or $2 or some shit like that. So moving on to a real world practical example. The market is declining, and you know this because the continuous trend following indicator is telling you to. Observe the negative trend line here, the brown line, is above the blue line. Therefore, we are in a negative trend. You can kind of see this going all the way back from up here. Quite a good signal if I'm being quite honest with you, but this is just an example. Number two, so we know we're in a negative trend. We're thinking to ourselves, okay, so is the bottom going to be coming somewhere soon? So you watch your continuous mean reversion indicator to show you if the market is nearing a bottom somewhere. You can see that it is. It's coming down here somewhere. But obviously, because it's a continuous signal, we don't know exactly where it will end. All we know is that it's kind of cheap or pretty cheap down here. So you'll also load up your discrete mean reversion indicator because now you know if you're going to get a bottom signal, it's going to be worth following because you have confluence or agreement between both types of mean reversion styles. So for example, up here, this is a great one, nice zoomed in here. We have the hot stochastic heat map strategy showing very, very hot conditions. And then we have a discrete mean reversion signal saying, yes, this is the top from Dan's Hunter algorithms. Holy shit, what an amazing opportunity to sell your bags. Moving down here, clearly we were still quite a bit hot, so this one was like, is it legit? We weren't quite sure if it was legit or not. Would have been worthwhile double guessing that one, but now we're entering very cold, very oversold conditions here. So if we get the Dorito to buy, then goddamn, we're going to have a very, very good signal there for a buy. So the time has come. The price is now within the threshold of the discrete mean reversion indicator. You prepare yourself for a signal. Things are looking very good. There it is. The continuous mean reversion indicator is showing signs of a very strong oversold condition. We are in dark blue territory now. This discrete signal is high probability, so you would take that trade. Okay, so the probability of the price entering a positive trend after this is quite high. Therefore, your next consideration will be to identify a strengthening trend. Strengthening indicates a continuous trend following requirement. So we can look at the magnitude of it. As you can see here, things are beginning to cross over. Now you can confirm the trend with a discrete indicator of some kind, perhaps a moving average crossover strategy. Or, as I've shown here, you can use the integrated discrete signal from your continuous indicator as shown. You can see here the DMI has now entered a positive trend because the blue line has just so barely jumped over the brown line. So we are having the beginnings of a positive trend. This is good. if you were running a system, for example, where you are only buying, say, half of your bags at the bottom using a mean reversion strategy, so 50% here, just in case we get a second bottom indicator over here somewhere, and you are still holding 50% cash, by the time you get this positive signal here for the strengthening trend, you'd probably, actually you would buy the remaining 50% here, and this would be the next position. So by this point, you would be 100% invested, and your average price would be very, very, very close to the bottom of this massive trend here. So overall, it's probably a good strategy. So at this point, you must start to think ahead and begin to look for exit signals. So let's classify it to ourselves. Remember back to the ones over here. Let's remember back. We're looking for overbought conditions from mean reversion, or we're looking at negative trend conditions from trend following. Yes, overbought or negative trend conditions. So as you can see here in this practical example, the trend indicator was actually the one which gave us the signal to exit, because the top threshold for Dan's mean reversion indicator was just a little bit too far away. This is why it's always important to use both. So you can see here where I've drawn the red line, that would be your exit. We would have bought here the remaining 50% of those bags, like I mentioned. So you would have had 50% here, 50% here, and your average entry would have been down here somewhere, about halfway between the both of them, which is logical, halfway between 50 and 50. And then your exit would have been up here somewhere, as you see this moving from positive trend into a negative trend. That was your exit indication. So you would have made the difference between about here and here. Overall, not an optimal trade, but it's better than nothing. That's following the rules, and that's a sound strategy. Sound strategy is better than just guessing. So also, if you observe a little closer as well, you can see here that we re-entered a short trend, we re-entered a long, we got chopped around a little bit, which is the case for all trend following strategies. You do get chopped a bit, but of course, we eventually re-entered a blue trend here, a positive trend, and up until the current day, the 29th of March, recording this one, this has remained in a positive trend. So that would have meant that you'd be at least 50% invested for the remainder of it, going back up through here as well. So what could go wrong if you ignore these principles? The most common problem I see among students is that they wait for another bottom signals because they missed the previous signal by one day, and they want to stick to the rules too tightly, and they start to panic. So they're like, well, I better stick to the precise rules. Hold cash all the way up a massive pump, because now, of course, we've hit the bottom and we're going up now. So they start to spam the general chat with, oh my God, is Dan's bot still working? Will the bot fire again? I'm patiently waiting for the next signal. At this point, everybody is celebrating wins and they can't take the pain of missing out. So they buy at the very top, just before the top signal fires, which of course they ignore. They then hold into oblivion, waiting until the next bottom signal, which they of course cannot buy because they have no cash left. One moment. Clearly, if you miss the signal, you've missed the optimal price for your entry. However, the uptrend confirmation is the next best opportunity to buy into a position and should be part of your overall strategy so that you don't end up looking like these motherfuckers. So what can go right if you use these principles? You will have a framework of contextualizing all market environments. When in an uptrend, hold until the uptrend is broken or the top is reached. When in a downtrend, don't buy until there is a significant bottom or until the trend reverses upwards. Following this, you will never be in a situation where you do not have the right tools to either enter the market or exit the market. This framework also eliminates the need for price targets, as you'll have a method of managing your exits which do not require you to predict the future, which is impossible anyway, but people genuinely believe that shit in 2022. I don't fucking know why. Everybody is obsessed with price targets because it allows them to jack off to their fantasies. It's bullshit. So, further research questions. Some hard questions to ask yourself, and you need to really think about these as well. It's going to be way too long to include in this video. What happens if your interpretation of a continual oversold signal is wrong? Continuous oversold signal is wrong for a mean reversion strategy. What happens if your discrete overbought signal is a false positive? So sometimes you have errors there, and this is the reason why stacking these different strategies are important. You're always trying to think ahead, think ahead, think ahead. So what happens if you're in a range and your trend signals whip you backwards and forwards? You need to be prepared for this psychologically. You need to be trying to determine when you're in these ranges and thinking ahead as well. This is probably more advanced. So how will you know which one of the 100 different indicators are relevant in each market environment? I mean, there's more than 100. I mean, 100 different indicators for each subcategory. There are so many different indicators out there that you can use. My highest recommendation would be staying in Hustlers University 2 over the course of many, many months will allow you to see which skills the professors use in each market environment to maximize these profits. No two market environments are the same, which is why seeing these skills in action month after month is critical. Guys, when we're moving forwards through the market, you can look back into the signals channels and you can be like, oh yeah, they use these things under these conditions. We are looking at so many things behind the scenes. We have paid data services coming in from all over the internet. We're looking at macroeconomic fundamentals. We're looking at sentiment data. We're looking at on-chain data. And all of these things are changing from month to month. And the same indicators that we would have used last month are no longer the ones we're going to use this month because we're expecting chop or we're expecting trends going strongly in one direction or another. Some of them are more appropriate to different situations. If you're a tradesman and you're going to a job and you've got your tool belt, you're not just going to have a hammer. You're not just going to have a screwdriver and a tape measure. You're going to have a massive toolbox full of tools. You're going to have files and hole punches, and you're going to have drills, and you're going to have drill bits, and you're going to have pliers. And this is what the professors show you in real time. So we can try and make as many lectures as possible, but shit, to actually see what we're doing in forward testing, you'll learn far more in that case. So please stick with us. In conclusion, price cycles go through the same approximate motions. Negative trend, oversold, positive trend, overbought, back around to negative trend again. Now, some of these phases can be skipped. Sorry, spelling error. Like chess, always be planning for contingencies because some of these can be skipped and you need to be prepared for that. So when performing analysis, be very clear and deliberate about what you're trying to achieve. Remember, the examples in this presentation are examples only. Nothing in this presentation constitutes the promotion of a specific strategy. But by all means, please take ideas from this, but please do your own research. There's a whole world of different indicators and stuff out there. Collect your favorite indicators that fit into each category by going on TradingView and saving them as your favorites. All right, thank you very much for your time, guys. Talk to you soon. Welcome to Hustlers University Lecture Extended Crypto Principles.